I think we have some really interesting things going on here. We had an exceptional rally on Tuesday. I said that I thought this sell-off was a 2-day bull flag and that we would test up to Tuesday's high. And this might be the start of that test up there. It's possible that we have one more leg down. We've had trading ranges for 2 days. We may go sideways like we did here, maybe create a head and shoulders bottom bull flag. So left shoulder, head, and then right shoulder. We have a nested pattern. We have a small head and shoulders bottom here, higher low major trend reversal. What I think is really interesting is the higher time frame charts. As you know, on the monthly chart, we have a bear bar. We have a parabolic wedge, a tight channel with 3 pushes up, 1, pull back 2, pull back 3. Usually you get at least some kind of a test down, maybe to the March or April lows, for a few bars, 2 or 3 bars. So that could be 150 points or so. Weekly chart, they have a bull flag, a 20 gap bar buy. The market has not touched the moving average in 40 bars. So that means there's a gap below this bar and the moving average, this bar and the moving average. In fact, far more than just 20 bars. Typically, if the bulls are willing to buy above the moving average, they are very happy to get to buy at the moving average, and therefore usually you get a bounce at the moving average if it's been above the moving average for a lot of bars. I think the problem that the bulls have is this climax is so protracted that the bulls, especially right here, 40 bars above the moving average is so extreme. I think the odds are the bulls are exhausted, and if that's the case, 3 bars down is probably not going to be enough for them to get rested and eager to buy again. Even if we go to a new high above this high, I think that we're in the process of starting a trading range. Certainly a minor trading range here for the past couple of months, but I think it'll be all the way down here. We have a spike pullback channel, and this is, I think, a target 2350, maybe 2300. It might take a couple months to get there, because if you get an extreme buy climax, the market usually tries to correct for about 10 bars, 2 legs. 10 bars on the weekly chart is about 2 or 3 months. Daily chart, we have a big high 2, 1 pullback 2, and I think it's really a wedge, 1, 2, 3, and we had a strong reversal up from that wedge. And that means the bulls are fairly heavily committed again. If it breaks below this low, in general, when you have an obvious stop location like that, the bulls have their stops below a good buy signal bar, good entry bar. When you have an obvious buy signal like that and the market falls below it, 50-50 chance the bear breakout leads to a measured move down. 50-50 chance the bulls will buy the breakout, betting it will fail, and the bull trend will resume. It depends on context. Now, I think that if we break below, it's closer to a 60% chance that we'll begin the move down here, because we have a spike in channel pattern, spike pullback channel, usually evolves into a trading range, and the bottom of the range is usually near the bottom of the channel. The weekly chart is so extremely overbought. Those are reasons enough. Now we get heavily committed bulls here, and they will be very disappointed if we break below here. So if we break below here, rather than 50-50 chance of a measured move down, 50-50 chance resumption of the bull trend, I think it's closer to 60%. And if we get a big breakout below this bar and then a bear follow-through bar, it'll be more than 60% chance that we've begun a correction down somewhere here. The bears, they have a major lower high here. They're in a bear channel, 1 pullback 2, right? And they just want to keep getting lower highs and lower lows. If the market breaks above this high, then the bear channel no longer exists, and the market would then be either in a trading range or a bull trend. Right now, I think it's more likely in a trading range or a bear trend. But if we break above this, the bears will give up. If we break below this, the bulls will give up. So really 2 very important prices. Seasonally, the market is bullish from August 26th, tomorrow, until September 5th, slight bullish bias there. So we could go sideways to up a little bit more, maybe to around this high, maybe all the way up here over the next week. I'll be gone next week, but I'll be back. I come home on September 6th, so I'll be back in the room September 7th. First bar, a doji bar. We broke above the bear channel, good. but not a strong breakout above the bear channel. So it looks more like today might be another trading range day. We had a doji bar here, we broke above, bad follow through, trading range. So we may stall around yesterday's high. In any case, I still think the bias is up over the next week, and I think that we're in a bear channel, and I think we'll get the bear breakout rather than the bull breakout on the daily chart. So I think we'll break below here rather than above here. When you're in a broad bear channel, which we are, we have lower lows, lower highs. Typically the bears buy back shorts on strong down days, especially at new lows, and then they look to sell again somewhere in the middle third of the last bull leg, last bear leg. So we're in that sell zone, and at any day the bears could return and get another bar like that. So this is the sell zone on the daily chart. Overnight, we have a breakout of a trading range, but bull bar bear, bull doji, bull bear, right? It looks more like a bull leg in what will become a trading range, so not particularly bullish. This looks like a limit order open, so probably sellers above, maybe around yesterday's high, and then buyers below, but they may not buy until we get near the moving average, so we could pull back below this breakout point and test down to the 60-minute moving average. 5-minute moving average will rise quickly because every one of these bars is replacing a low price bar, and that will make the moving average move up quickly. You're exchanging a high price bar for a low price bar 20 bars ago, and that will quickly raise the moving average. Daily chart, we had a buy signal bar 2 days ago, but it was a doji, and it was in the middle of it was a disappointing follow through after that bull bar. You know, I said that we may go sideways for 2 or 3 days, so today could be the third day. I still think the odds are we're going a little higher, and then I think the odds are we're going to break below the low. You know, I've said we're in a bear channel. We are. We're also in a trading range, and we're also in a bull trend. We're getting major higher lows. However, I think it's more likely that we've begun a correction down to these lows than it is that we're going to go significantly higher from here. Can you buy with a stop above bar 1 or sell with a stop below? I would not. You know, to me, it's a limit order open, and therefore it's better to wait to see what we get. Obviously, if we get this over the next couple of bars, then we'll probably get that. But right now, it's unlikely that we're going to get that. More likely that we're going to have more of a trading range open, like this kind of a thing. You know, it goes down a little, goes up a little, down a little, and then decides the direction of the first swing. Trading range day, likely at this point. We did not break strongly above yesterday's high. Yesterday, not a strong buy signal bar. We have a 2-day trading range. So in trading range, you typically have a swing up and a swing down, lasting 2 to 3 hours. And, you know, yesterday we sold off for a couple hours, rallied for a couple hours, sold off for a couple of hours. But early on, the market has to decide on the direction of the first swing. Will it be a test down here to the 60-minute and 5-minute moving averages, yesterday's close, or will it be up to Tuesday's high? If it gets there, the bears will try to get a double top. We still have another trend line above. I'll put up a 15-minute chart. A trend line from the all-time high to this major lower high. This was a major higher low, and the bear is going to break out below it, and it reversed up. This is a major lower high. We still could get there and form a big double top. So double top neckline, and then measure move down to 2300, 2350. So there's plenty of room left for the bears. The market can go quite a bit higher and still be bearish. The bears would still have a reasonable argument, even if it goes another, 30, 40 points higher. Pair of doji bars, okay? So quiet open. I mentioned yesterday in the middle of the day that a bunch of retail stocks that sell groceries did this. Right, there's Costco, Walmart, a bunch of retail stores. Okay, and it turns out that was the announcement that the deal between Amazon and Whole Foods went through. That Amazon, in fact, is going to buy Whole Foods, and not only that, Amazon announced that it's going to dramatically cut the price of groceries at Whole Foods, and everyone is very respectful of the power of Amazon and the great management of Amazon, and therefore if you're selling groceries, you're probably going to lose some market share to Amazon, and that's why all of those stocks became suddenly less profitable around 11 o'clock yesterday. So do you sell at the 2 high or 1 point higher? Or do you wait for 3 to close and then you buy the close? Right now the odds are this is a limit order open with sellers starting to sell at the 2 high and selling higher. And it also increases the chances that today is going to be another quiet trading range day. What do you think at this point? You're thinking, darn, we broke above the trend line, but we did not break above yesterday's high, and we did not get strong bull bars the way we did over here. We did not get strong bear bars like we did yesterday, and this is probably going to be a limit order open, and it's probably going to be a range for the first hour or more, and it increases the chances that the entire day will be a trading range day. You can always get a breakout up or down, but given we have a gap up that did not break too far up, did not break above yesterday's high, and the follow through after the gap up has been bad, the odds are against a big bull trend day. And we're not reversing down strongly from resistance, the bear trend line, yesterday's high, and there's just no energy, and we have support not far below. The odds are against a big bear trend day. So if it's not going to be a big bull trend day and it's not going to be a big bear trend day, it's probably going to be either a weak trend up or down, like a trending trading range day or a broad channel, or a trading range day. In either case, it's probably going to have a lot of trading range trading. So it looks like we might have a limit order open for the first hour or so before the market decides on the direction of the initial swing. Look at yesterday. All right. The market went sideways for a couple hours, and the initial breakout did not get very far, and the bear breakout did not get very far. The market stayed in a fairly small range, not yesterday, 2 days ago. The market stayed in a very small range all day. And right now this is a comparable type of day. What happens if we get a pair of big bear bars like this? Well, we'll probably go lower. And likewise, if we get a couple surprisingly strong bull bars, we'll probably go higher. Right now, that is not likely. Now, something subtle going on here. I talked about this over here. Close at or above the close of the prior bar. Close at or above the close of the prior bar. Here and here. And it's a sign of buying pressure, and it increases the chances that you can get a bull trend. And right now, we have a close above, at or above the prior bar's close, close at or above the prior bar's close. If we get 4 or 5 or 6 bars like that, that would increase the chances that we're going to get a bull breakout. Do I think we will? No. We got 3 doji bars, and we're at resistance, yesterday's high. So I think that is not likely. Okay, so it's 4 bars now, right, with trending closes. Bar 1 closed above yesterday's final bar. Bar 1 closed above this close. So, to me, it's interesting. It's one of those subtle things that you look at and you just see the dojis and you say, it's nothing. Well, it's not. The bulls, why are the bears allowing the bulls to do that? Right? So, there's something real here. and it makes the market always in long. Here we have a high 2, but and we have trending bull closes, but we're still at the top of a tight trading range. So a lot of bulls are hesitant to buy until we get a good breakout. Because of the trending closes, I think we're always in long regardless. We have a gap up and then a small bull bar on one, but that we have a subtle sign of buying pressure, and it increases the chances of a bull breakout. What happens at yesterday's high? Do traders sell? We have the 4 dojis, which is neutral, but we have those trending closes, and you have to be really respectful of that. It's subtle, but it's important. Surprise bar, right, increases the chances that we'll go at least a little bit higher. The bears want another trap like we had yesterday. Odds are we'll go at least a little bit higher. Suppose we get a bear bar after 5. It'll be like 47 yesterday, a failed breakout. But the reason I did not sell below 47 yesterday was it was only a 1-tick bear body. If it's a 2 or 3-tick bear body closing on its low, I think bears will be more willing to sell below 6. Breakout point yesterday's high, so we might pull back there. Strong bar, probably higher, 5 consecutive bull bars, 5-bar bull microchannel. Theoretically, you have bears who sold yesterday's high and are scaling in higher, and they're selling here, trying to get back below here to avoid a loss. But that's a pretty good looking bar 5, so I think we're probably going a little higher, maybe a lot higher, but certainly a little higher. A lot of times I'll put up a 1-minute chart in a situation like that, and then buy a close, at least for a scalp. I either buy a close or buy a pullback, right? But when you get 4 bars up, closing on their highs like that with good bodies, I usually just hit and buy the market. On the open, there's often a strong move up or down. Yesterday's strong move down. 50% chance the strong move reverses, and 50% chance it's the start of a trend. And that's the math right here. And you look at it and say, well, how can that be? How can we get such a strong rally and then have a reversal? Because that's what happens on the open. The market's always searching for a trend, and it's probing, and it's testing the bulls and bears. Are the bulls strong? Are the bears strong? And a lot of times when you get the strong rally, the bears will start to sell aggressively, knowing there's a 50% chance the rally will fail and create the high of the day. To sell below 6, I think the bears need a close on the low, and did not get it. So probably buyers below 6. The bears did not do what they needed to do. You can see we're testing the high of yesterday. We broke above yesterday's high and rallied 10 ticks, so the bulls made 2 points. And you have scale and bears who sold yesterday's high, and they're selling 1 point higher. They needed to fall 2 ticks below 6 to get out break even on their first entry. I think we're always in long, and I think that 6 is not strong enough for many bears to take that short. So probably buyers below 6. Bad follow through, that reduces the chances that this is the start of a big bull trend. And then we had 4 dojis on the open, even though we had trending closes, and we still, we have 5 bars with trending closes. It does not look like the start of a strong bull trend. Trying to get back to Tuesday's high. The top of the, very strong buy climax. Today they're having that Jackson Hole, Wyoming Economic Policy Forum, and therefore, we have an increased chance of news. Here's the euro. All right, so somebody said something. I'm guessing somebody said something in Wyoming. Well, the bears, parabolic wedge, 3 pushes up, 3, 5, and 7, but they need a signal bar. Also, we now have a 7-bar bull microchannel, and therefore probably the bulls are so eager to buy that they'll buy the first reversal down. So not a lot of downside risk, even though the market often has a strong move on the open that reverses. So I would not sell below 7 or 8 because there are probably buyers there. What about my opening comments that the first several bars of the day made a trading range day likely? Well, look at the breakout on bar 5. What happened on the next bar? A bear bar. And that's also consistent with trading range trading. And look what just happened above 6. Bears sold the 6 high and 1 point higher and made money. And that's also consistent with this being a bull leg and what will become a trading range. I don't know if the trading range bottom is down here or if it just goes sideways, but so far the bull trend is not like this. It's not, where are the consecutive big bull trend bars? Not a very good looking sell. Micro double top, up 6, down 6, up 7, down 7. But probably the first reversal down will be minor. Parabolic wedge with 3 and 5. However, usually when you get a parabolic wedge top, if you get a reversal, you get an endless pullback like this for a number of bars. So the downside risk over the next 5 bars or so is not great unless we get a surprise, a big bear reversal. More likely the best the bears get is, the market pulling back for 5 or 10 bars in a fairly tight range. Let me just see, like this for 5 or 10 bars. Or this pullback for 10 bars to the moving average and then got higher prices. Pullback, higher prices. Pullback, higher prices. Pullback for a lot of bars. So, parabolic wedge, yes, but odds against a reversal within the next several bars. Gap up, bad follow through. Bull breakout, bad follow through. Another breakout, and the bar had a big tail on top. I am back to flat. We're always in long, so that means I still believe it's more likely that we'll go up at least a little bit. And so I think we'll either be sideways to up rather than sideways to down. Globex chart, wedge 1, 2, 3. Testing Tuesday's high. Head and shoulders bottom bull flag. Left shoulder, double bottom for a head, and then right shoulder. It might be that the limit order bears from yesterday's high are still holding. You know, we're not getting consecutive big bull trend bars, so they might still be holding, hoping for the market to dip back below yesterday's high. Right now, we've had 7 bars, 1 trend bar, and therefore I think we probably will dip back below yesterday's high and allow the limit order bears to get out break even on their first sell at yesterday's high, and then with a profit on whatever additional sell they have. 8-bar bull micro channel. While it's always possible the first reversal down could create the high of the day, the odds are against it. More likely buyers below 8. IOI, but only 1 bear bar and 9 bars, and no pullback in 8 bars. Low probability sell. For the bulls, it's an IOI and a bull trend, so theoretically it's a buy above 8. But because we've only had 1 strong bull bar in 8 bars, a lot of bulls are more interested in buying pullbacks. And the bears see that they made money selling at the 6 high, so they probably will sell around the 7 high, which is up there at, this is a 15-minute chart, up at Tuesday's close. Remember, it was by the close right up to the last bar of the day, and some bulls bought that close thinking that either the market was going to gap up the next day, it did not, or if it sold off, it would get back to that close within a few days, which it's doing right now. You can see we're right at that high close, and the scale in bulls who bought that close and bought more above a bull bar here or here are now taking profits. They're disappointed by how deep the pullback was, but they were confident that if they scaled in, they would make money on their lower entry and get out break even on their first entry. And you can see we went right above Tuesday's close and we pulled back. All right, so that's a sign that the disappointed bulls were using this rally to get out of their longs. Parabolic wedge, but with only 1 bull bar and 9 bars, a lot of bulls are hesitant to buy above 8 or 9, despite a bull IOI and a 9-bar bull microchannel. It's really pretty interesting, right? We have 9 bars and only 1 strong bull bar. Always in long, 9-bar bull microchannel, but not a lot of aggressive buying. And markets deciding, is this simply a sell vacuum test of that high close on Tuesday, or instead is it the start of a bull trend day? And nobody knows. In general, when you have a 9-bar bull microchannel on the open, it's better to wait for a second entry sell. There probably are more buyers below 9 and even below 7 for that matter. Again, not only trending lows microchannel, and we also have trending closes. We've only had 1 close all day and 9 bars that close below the close of the prior bar. So even though we only have 1 bull bar 5, there's still subtle buying pressure, and I think that makes it better not to take this sell, even if it's a bear bar. I would wait for a second entry sell or for a series of bear bars and then sell. Right now, the odds are there are buyers below. So what do? I think it's better to wait for a second entry sell. We have a 10-bar bull microchannel. Bulls buying at or above the low of the prior bar for 11 consecutive bars. And that means that they're very eager to buy. And if they get a chance to buy below the low of the prior bar, they probably will take it. Therefore, this is probably a minor reversal. We have a parabolic wedge and we have a small double top, but I would like to see a second reversal down before selling. Really pretty interesting. We have that one bar, and that was it. Terrible follow through. Possible high of the day. Location really good for the bears. We get the limit order bulls from Tuesday exiting, at least some of them. You can see daily chart. We're at the moving average, 60-minute chart. That is the daily moving average. So resistance. And we're in the middle third of the most recent leg down in an early bear channel. So this is the sell zone for the bears. Even if we get up here, the bears will try to get a double top lower high, major trend reversal. The bulls need to break strongly above this high. It's a major lower high. And as long as the bears are able to keep the market from getting above that high, they're in a bear channel, and they'll try to get a breakout below this wedge bottom, 1, 2, 3. And if they get a breakout, in general, 50-50 chance when you break below an obvious stop location, the breakout fails and reverses up again, 50-50 chance it succeeds. But if you get a strong breakout, especially with follow through, then close to 60% chance we've begun the correction down to these lows. And for the bulls, this is a major lower high for the bears. They want a breakout above that major lower high so that the bear trends conclude that it's no longer a bear trend. It's either a continued trading range or a bull trend. Five ticks above 10 and then a little pause. So a lot of the bulls above the 10 low scalped because we're in a pretty tight range. Whenever you have a strong rally for the first hour or so, the market often goes sideways for 2 or 3 hours and then decides between trend resumption up and trend reversal down. Strong rally, trading range. We got trend resumption up, it failed, and we got a reversal down. Strong rally, trading range, trend resumption up. Limit order bears made money selling above 6, selling above 9. Limit order bulls made money buying below 10. So tight trading range, limit order market. The bears want to get 3 consecutive bear bars. They'd like to get one huge bear bar. They want this, but they're probably not going to get it. Instead, they'd like to get this, maybe 3 consecutive bear bars. And that would be enough to make a lot of the always in long bulls step aside, exit and wait for a better bottom. This is the end of the first hour. Bull breakout of a bull flag. We have a bull trend, a bull flag, and a bull breakout. So far, tail on top, not a strong entry bar, but still bullish. Bears trying to get 3 consecutive bear bars. So what do the bulls do? I would be in scalping mode, or I am in scalping mode. So it's not like I would be trading this always in long. And for the bears, you can argue it's a second entry short, 10, 11, but we're at the bottom of a tight trading range and at support, yesterday's high. I don't want to be selling this low. So right now I'm trapped out. The bears' second entry short failed breakout yesterday's high, but why can they not get a better signal bar than 12? So I think while it's possible this is the high of the day, we have a parabolic wedge in the second entry short. I think it's more likely that we're going to go sideways here. You can call it a small wedge bull flag, 3 pushes down, 9, 11, and 13, but not a particularly strong buy. We're in a tight trading range. The bears have 3 consecutive bear bars, but I still think we're always in long. Bulls double bottom 7, small wedge bull flag. Maybe on a smaller time frame chart, that'll be a more obvious wedge. Let me look at a 2-minute chart. So, 1 push down, pull back 2, pull back 3. I think the math is difficult here to do anything. If 14 closes on its high, it's probably an okay buy, betting that the double bottom will hold. Okay, did not close on its high. Getting a bear breakout below a wedge bull flag. Again, parabolic wedge top. Are we always in short yet? Well, we probably need one additional bar beyond bar 15. But right on the open, I said probably mostly a trading range day. And then when we get the bad follow through 6 and then the tail 7, I said probably bull leg in what will become a trading range day. I was not sure if it would be a bull leg and then have a bear leg, or a bull leg and simply go sideways. And that's what the market is deciding right now. You have limit order bulls 14 low. And if we get back above that 14 low, that would increase the chances that we stay mostly sideways. If we get another decent bear bar 16, that would increase the chances that we've begun a 2-hour move back down to the low of the day in the 60-minute moving average. Trading range days, the first leg often only lasts an hour or so like this, and then the second leg usually lasts 2 to 3 hours. It looks like this is more likely than not the start of a second leg, so we're probably always in short, but a lot of traders want to see the close of 16. Bears selling. If they sell, and they are selling, stop above 11, and they have to scale in higher, because there's always a possibility that this is going to be a trading range, and if it's a trading range, the bears could there could be a deep pullback from the sell-off, right? The bears are selling here, believing that it's always in short, and therefore the best the bulls get is a trading range. The bears sell, hoping it keeps going down, and knowing that if it goes up, they can scale in more, stop above here, and usually avoid a loss. We're testing the biclimax low, the 5 low, so there'll be some buyers here. Bulls will buy the moving average, they'll buy the 5 low, but I think we're probably always in short, and therefore it's probably easier to make money looking to sell above bars, sell a 50% pullback. You have scale-in bulls who bought below 10 or below 14, so we'll probably test at least the 14 low over the next few bars. For the bulls, they want to get a double bottom, opening reversal up from the moving average. And sometimes when you get a big gap up and you get a big sell-off like this, you do get a double bottom for the low of the day, and the market rallies for the rest of the day. However, the initial rally was not very strong, the gap was not very big, and the sell-off is reasonably strong, 4 good bear bodies, and therefore more likely sellers above scaling in higher. We have a sell climax 15-16, so the bulls are going to try to get to the 15 high. We have limit order bulls who bought below bars, below 12, below 14, and we'll try to get to those lows. I think we probably will. However, I also think the bears will sell rallies. If 17 is a bad buy signal bar, they'll sell the 17 high. If it's a questionable, maybe a reasonable buy signal bar, they'll look to sell higher, like around the 14 low and the 15 high. Not a great buy signal bar, but looks like a trading range day. Probably bears will sell. They'll certainly sell up here. They may start to scale in at the 17 high. If they do, they'll trade small to allow for scaling in higher. Might test yesterday's high again. Gap up, deep pullback to the moving average, became a double bottom, and we rallied. Gap up, double bottom. Gap up, strong sell-off to a double bottom, but bigger gap up, stronger rally. Higher chance that the bulls would get a reversal up, a double bottom, opening reversal at the moving average. Here we got below the moving average. The sell-off was stronger, the rally was weaker, and the gap was smaller. Therefore, more likely sellers above, and we're always in short. The market's deciding right now between a trading range day, most likely, look at the first 4 bars, and a bear trend day, maybe getting back down to yesterday's close. I think the chance of a bull trend day here is less. We're getting near the end of the first 18 bars. Whenever the market is near the high around the first 18 bars, if it reverses down, traders sell, betting that it'll be the high of the day. Whenever the market is near the low of the first 18 bars, right around bar 18, this is bar 18, traders buy the reversal up, hoping that this remains the low of the day. But not a good buy signal bar, 2 big bear bars. I think more likely sellers scaling in above. A low one short after a fairly climactic move at support, low of the day, and the moving average. Can you buy down here? Excuse me, I would not buy down here. Right? I say that. I think it's not a great short. We'll probably get support around the 60-minute moving average, so there probably will be some bulls buying down here. But I think most traders want to sell higher. If we go sideways here, then we get a wedge bottom, and bulls might buy for a scalp up. But right now, we've probably seen the high of the day. This is a breakout below the low of the first 18 bars. 90% chance we're not going to get back up here again. So 90% chance we've seen the high of the day. So that means either bear trend day or trading range day. However, when the sell-off is not incredibly strong, it's good for the bears, but not incredibly strong. Plus we're at resistance, at support. We're probably going to get a bounce. But traders will sell the lower high. Breakout below the low of the first 18 bars, we had a double bottom, yet we rallied and traders sold the lower high. Breakout below the 18 bar low and rallied. No, I don't think of this as really an 18 bar breakout. It's too late in the day. But 18 bar range, we got a bear breakout and we bounced a little bit. So I think we'll probably bounce a little bit. So what I'm saying is it's probably better not to sell here. We're right at support, 60-minute moving average, the breakout above this high, and it looks like a lot of trading range price action today, and therefore probably not much down before we pull back. Limit order bulls bought 17 low, so far trapped out, but I think they'll probably make money. Bears want a measured move down. They see an attempt at a double bottom, and they're getting a bear breakout below the double bottom, and they want today to be a strong bear trend day, leading to a measured move down. More likely, because of all the trading range price action, we're going to get a bounce, and the bears will be able to sell some kind of a lower high. Sometimes you get this, you break below the 18 bar low, and you just keep going down, down, down. 18 bar low, strong breakout, pull back, right? So I think we will get the pullback. This might be like today, strong breakout, fell, a couple points below the low before we get the bounce. This is unusual. We had the 18 bar breakout and we went all the way back up to a new high. 10% of the time you get that. Parabolic wedge bottom. For the bulls, they see this as a bull trend, and then this as a 50% pullback, a wedge bull flag, opening reversal up at the 60-minute moving average. You got about a 10 bar bear micro channel. We should get back above the 17 low. We may get up to, I think we probably will get up to the 19 high, the top of the most recent sell climax, and we'll probably get a couple legs sideways to up. What happens if by the close of this bar it's another big bear bar? Well, I'll change my mind, but I still think this is a trading range day. However, I also think it's probably going to create a lower high. So like this, minor reversal, and then another test sideways to down. Here it was also finding support, 60-minute moving average. So what do? Well, I think at a minimum you get out of shorts above 20 and you wait a few bars. We're at support, and to me it's a wedge bull flag after the trend that began at yesterday's low. And we have a lot of trading range price action. Bear bar, doji, bear bar, bull bar, two bear bars, doji, bear bar, strong bull reversal. Just like the same problem on the way up. The lack of consecutive strong trend bars makes it more likely a leg in a trading range than the start of a strong bear trend. Sellers above 19 sell climax high, moving average, maybe a 50% pullback, maybe here's the sell-off, so 50% is right around here. Can you sell the 20 high? I said traders would sell the 17 high. What's different? Well, what's different now is we expected a second leg down. One pullback, two, we have the second leg down. 17 high, double bottom, but probably a second leg down and big tail on top, so probably sellers above there. Here we have a wedge bull flag, 50% pullback, and the second leg down and a good looking buy signal bar. So I would not sell the 20 high. I would either buy it or wait to see what we get. Maybe we'll go sideways for a few bars and get a second entry buy. That's always a higher probability, like over here. But this sell-off was stronger than this sell-off. This stair step down, and it's a parabolic wedge. I have the wedge drawn using the 6 low. Some computers will use the 13 low for a parabolic wedge, 13, 16, 20. You sell below 20 for a failed breakout, a failed wedge bottom? I would not. I think probably buyers below 20. It's an obvious stop location. My general guideline is if there's a buy signal and the market falls below the obvious stop, 50-50 chance you'll get a measured move down, 50-50 chance you'll get a reversal up. I think the probability for the reversal up is higher than 50% here. So I think the chance of the measured move down is less. So I think we're at support. We have a parabolic wedge. We have bad follow through on the way down. We have a bull leg in a trading range. This is probably a bear leg in a trading range. So probably sellers above, buyers below. I personally would not buy the 20 high. I mean, I shouldn't say that. I would. I think it's okay if you use a wide stop, but you may have to use a pretty wide stop. I think we're going higher. I think we're still always in short. I think it's a minor reversal, but I think we'll probably go higher, get up to this general area. And at that point, probably the bears will sell. A wedge, so you're going to be thinking of a couple legs up, one pull back, two. So one and then pull back, two. Now, who would sell below 20 or 21? Well, an institution might do it, an individual trader. I think the math is just bad for that. We have a lot of trading range price action today, and we're fairly low. We're 10 bars down for 10 bars. So probably buyers below 20 and not a measuring gap. Maybe 40% chance of a measured move down, 60% chance buyers not far below 20. So what happened to that great looking bear flag, right? So like I said, 60% chance exhaustion gap and 40% chance measuring gap. So it was a gap for an instant. The close of 22 was below the close of 20, and that gap closed immediately. Bulls trying to get this, a second good buy signal bar after a strong sell-off. That would be a higher probability buy above 22 if the bulls do get a good bull bar. Now, what do those low one bears do? 21. They're obviously trapped. They got a 5-tick trap, and it reversed quickly back above their entry price. So they know they're in trouble. They're hoping that we simply go sideways, but since this is more likely a test of the 60-minute moving average and yesterday's close, I think we'll probably go sideways to up to that 19 sell climax high. Makes it tricky, right? We're in a bear trend, and the market's asking traders to buy with a stop, and the buy signal bar 22 is big, and therefore the risk is greater. They sold a second failed breakout above yesterday's high, breakout failed a second time. Now the bulls have a second failed breakout below the open of the day. Here's the first, here's the second. I think if we get above 22, the odds are we'll go up at least enough for a scalp, but the math is not great because the size of 22 is big, and therefore the risk is big. For the bears, they're trying to protect their stop above 21. They have a low one bear flag, and they see the micro double bottom. They see the moving average. They see the 50% pullback, and they will probably buy back their shorts above 22. It's still a buy above 22, second failed breakout to a new low of the day. Parabolic wedge, second entry buy. And for the bears, it's a low too short, but we're finding support at the 60-minute moving average, and the sell-off has had bad follow-through all the way down. So the odds are we're going to bounce, and therefore it's a low probability sell below 23. The bears who sold below 21 still have their stop above 21, hoping that we get a measured move down. It's more likely that we will not. It's more likely that we're going to reverse up to this general area. A better looking sell. The bulls have been unable to trigger the buy above 22 and unable to run the stop on the bears. But I have to say we're right at the 60-minute moving average. We have a tight trading range. I am not taking the sell. Suppose we go outside up here. I still think it's a buy above 22, but again, I think we're still always in short. You certainly could buy for a swing. The probability is probably high enough for a scalp, even though the risk is greater than the reward. Maybe we'll get up to the 18 high, which would be 2 points, and then the risk would be about the same as the reward. The bears, a low to short, bear trend, but at support, tight trading range, and trading range price action all day. That makes this a low probability short. Remember what I said on the open trading range day? Sometimes the first leg is only an hour or so, but then the other legs are usually 2 to 3 hours. And this has been going on now since bar 7, so almost 2 hours. And therefore, I suspect that we'll get a lower high and we'll have to test back down. But the lower high, I think, will be high enough for the bull scalpers to make a scalp. Is it a buy above 25 if it remains a doji? I think you expect it to be difficult. It's a trading range day, so you expect nothing to look the way you want. I would not be surprised if 25 remains this size and then it becomes a buy signal bar, but the high of the buy signal bar, 25, is still 2 ticks below the top of the ledge, making traders hesitant to buy. That happens all the time in trading range days. You get reversals that just don't look good enough. So the probability is never as high as you want. Can you sell below 22? I would not. We're trying to get down to yesterday's close, and it's possible we can go outside down, but right now I think we probably will not. So reverse down from yesterday's high. I think we'll reverse up from around where we are or somewhere above yesterday's low. Probably buyers 22 low. I had a buy stop to buy above 22 and I canceled it. So now I'm waiting, and I thought about buying the 22 low and I did not. That was a mistake. Tight trading range, new low, not a good looking sell. Difficult stop entry buy, even though I think it's more likely that we're going to go up to those targets above. If we go up, maybe a measured move up. The bears are still short. I think they get out above the 24 high. And I think they will get stopped out. The bears are trying to prevent their stop from getting hit, so they're selling here, hoping that we just channel down. But the odds are we are going to go above 22. It's, I say odds are, I don't say it's 60% chance. It's better than 50-50 that we'll go above 22. But sometimes you get these endless channels that just keep going down and down and down. This went down for a couple of hours. You can see the bears trying to defend their stop. Okay, they just got stopped out. Sometimes in a situation like this, I look at a lower time frame chart and enter early. I did enter on the 3-minute chart because it allowed me to buy a few ticks below the 40 high, and I thought we could break a tick or two above the 40 high and immediately reverse down. So I thought I had a better chance of a profit entering a little bit early. What do the trapped out bears do? Are they going to sell again right here? Well, think about it. If you were selling all the way down, we're at support, and you repeatedly try to get another leg down and are failing, and you see a lot of trading range price action, and you see bad follow through on the way down. Once the stop gets hit, you have to think maybe it'll go up for a couple legs. That's typically the case when you have a wedge. We have a wedge here and we have a smaller wedge here. The odds are we're going to get at least a couple legs sideways to up. If you're a bear and you believe the market's going to get a couple legs sideways to up, are you going to sell the first leg? No, you're going to wait for the second leg before you sell again. And therefore, the odds are, we'll go up at least a little bit more. Obvious target, top of the sell climax, the 18 lower high, around a 50% pullback. I have the pullback here drawn from the high of the day, but it might be from the top of the bear trend. In any case, it's around that 18 high. For the bears, a pullback in a bear channel, a double top 18, double top 22, but parabolic wedge plus a small wedge plus a failed low 2, probably buyers below, and at least a small second leg sideways 2 up. So what do you do? For the bulls who bought, a lot of them scalped. You can see we went 6 ticks above 26, the bull bar, but only 5 ticks above the 22 high. But that was my concern, that we may not go too far up, and the bulls who bought on smaller time frames would scalp, and the bulls who bought below the 24 high would scalp as well. And that often means that you get a pullback before it goes 6 ticks above that 22 or 24 high. That's why in a situation like this, I often try to enter early. I could have just used a bar chart and bought it as a second reversal up from the break below the low of the open, just like we had a second reversal down above yesterday's high. Here we're getting a second reversal up from support, the low of the open. And, just ignore the bodies and just enter with a stop on the reversal. A lot of times I'll do that. A lot of times I'll put up a bar chart. A lot of times patterns are clearer on the bar chart than on a candlestick chart. Especially when there's a lot of trading range price action, when the candlestick patterns are not as clear as you want them to be. It makes you lose sight of the forces that are going on. So if you ignore the candlesticks and just look at the bars, a lot of times it's easier to understand what the market's trying to do. For the bears, double top 22, double top 18, but we have a nested wedge, probably buyers below. Because the bears closed 28 on its low, a lot of the bulls will hesitate to buy the low, but I think there'll be buyers below and we'll get a second leg up. Can you simply buy at the market and put a stop 1 tick below 28? That's interesting. Since 28 is a pretty good bear bar, it's important that the bulls do not let the market trade below its low, and therefore you have bulls buying here, putting a stop below 28, risking 2 or 3 ticks, trying to make a couple points up. They know that there's probably a 70% chance their stop is going to get hit, that we're going to trade below 28, but 30% chance of winning. So they're risking 2 ticks to make maybe 2 points with a 30% chance of success. The math is good. The trader's equation is good, but you have to be willing to lose 70% of the time, and that's not fun. And therefore, I usually do not take that kind of a trade. Even though it's profitable, I don't want to lose 70% of the time. I want to win. It's fun to win. What do you do if you get 3 consecutive bear bars? I still think the odds are second leg sideways to up. We have a nested wedge at support, 60-minute moving average. So I still think more buyers than sellers here. So I did not take the 28 short. I did not buy because 28 closed on its low. It's like yesterday, 47. You know, I did not want to buy because of the bear body. You know, this is comparable to that. You know, with the bear body 3 bars down, bear body 3 bars down. Context is different. Here we have a lot of trading range price action, and we're near the bottom of the day, the low of the day. So I think more likely there'll be buyers here than sellers. Do you buy above 30? Let's say as a 1-tick bull body. Well, the odds are we're going up, or at least sideways to up. But you know, with those 2 bear bars, and if we get a 3rd bear bar, a lot of the bulls are hesitant to buy. If I had to be long or short right now, I'd be long. But because of those bear bars, I am flat. The 3 bear bars, I think, make the buy have less probability, and we may have to go sideways here for a couple of bars and create a micro double bottom. I still think we're going higher, but obviously a disappointing buy setup. The bulls buying stop below 25. And what happens if we fall below 25? Well, probably the same thing that happened when we fell below 20 and below 22. There'll probably be buyers below 25, and we'll form an expanding triangle bottom with 22 and 25. It's important that 28 went 1 tick above 17, the 17 low, because it meant that scale and bulls made money in a bear trend, and they made money below 20. They made money below 22. They probably will make money below 28. The odds are we're going to try to go higher. This might end up as a wedge lower high. You know, some days just get in a wedge type of mood, and they just form wedges all day long. You know, we have a parabolic wedge top, parabolic wedge bottom, and if we get up here to around the target, the bears would try to get a wedge bear flag. I'm going to get rid of this measured move because I don't think we'll get there. Limit order bears made money, 24 high. They'll probably make money selling the 28 high, selling the 18 high. The bulls are trying, the bulls are hoping this is just a bull flag. So bull trend here and bear channel bull flag. They're hoping it's a bull flag and that we resume up strongly. Right now, 90% chance we will not get back up to above the high of the day. We broke below the 18 bar range fairly strongly. And therefore, whatever rally we get will probably stay below that high of the day. We could trend up all day. Sometimes you get that. Sometimes you get the 18 bar breakout and it just rallies for the rest of the day. So we'll get the breakout of the 18 bar range and we just rallied for the rest of the day. Here we rallied for a lot, you know, for over 2 hours. Right before the bears came back, but it never got back above the top of the range. Here we rallied all day. We did get to a new high. I'm going to put this down here with the failures. Breakout below the 18 bar range, bear trend. That's not today. This is kind of more like today. Breakout below the 18 bar range, probably a lot of trading range price action. So, you know, I think we'll go up. I don't think we'll get this kind of strength, but I think we'll go up and down. This is really late in the day, this reversal, and the market just rallied for the rest of the day. So of the examples I have saved, this is, I think, the most like today that will rally but form a lower high and then get a leg back down. I think the next few weeks could be very interesting. We have a couple, 3 central bank meetings in September, and that always creates the possibility of a surprise. And you know my feeling about what's going on. Weekly chart, we have a 3 bar pullback. that's probably not enough of a pullback after this much of a buy climax. Let me do it this way. Weekly chart, 3-bar pullback to the moving average, probably not enough of a correction after a buy climax this big. Probably need 10 bars, 2 legs sideways to down. This is the first leg down. Even if we break to a new high, the rally will probably be simply a bull leg and a developing trading range, and the bottom of the range will probably be down here, but it might take a few months to get there. Daily chart, we have a wedge bull flag. I think it's more likely a bull trap, and that rather than break above the major lower high, we'll break below the low. It's a little bit tricky. I'm going to be away next week, and I don't know, I might trade some. I'm going to try not to, but we're in a sell zone. The seasonal bullishness lasts until September 5th, and I get back on the 6th, so it's possible on the 5th I'll take a look at the charts and buy VXX or buy puts or put spreads, but it depends on what the market looks like. But right now I think it's more likely than not that December is going to be kind of crazy, that we'll break below the wedge bottom and test down. It might take a couple months to get there. The seasonal bullishness usually begins in the middle of October and through April. That's the most bullish time of the year. And consequently, a lot of times the market sells off in September and October, and then it enters the bullish phase. So we're in a window when we have the potential for a sell-off. If you think about it, if the market is bullish October through April, and it is, that means it's usually bearish going into the start of that bullish time. So a lot of times you sell off in September or October. Monthly chart, right now it has a bear body, and right now I think it probably will not close below last month's low, so it probably will not be outside down, but there's probably not enough time left to have it be a strong bull bar. So probably it'll either be a doji bar with maybe a small bear or bull body, or a bear bar. Either case, it's good for the bears. We have a parabolic wedge, 1 pullback, 2 pullback, 3, a 10-bar bull microchannel, which is extreme, and therefore we should start to get a pullback. And this month would then be a sell signal bar for a pullback in September. Pullback in a 10-bar bull microchannel, maybe 2 or 3 bars. 2 or 3 bars is 2 or 3 months, maybe down to these lows, and that's 150, more than 150 points below. It would still be a bull flag on the monthly chart, but it would be a pretty nasty looking chart for the daily traders. It'll be a bear trend down here. Well, that's a wedge, 3 pushes up, 1, 2, 3, but most likely we're going at least a little higher. It's possible that we can get a surprise breakout on a trading range day. Anything that happens is not a surprise. You have to expect low probability events, and you have to expect disappointment. So even if the bulls get a strong breakout, the odds are they'll be disappointed, because the odds are we will not get to a new high of the day. Bulls see this as a bear flag, like yesterday we had a bear flag, and want a bull breakout, like yesterday. However, they don't want a second leg trap. And the bears see this as a wedge bear flag, 3 pushes up, 1, 2, and 3, and they're looking for a test down. The problem with the bears is we're finding support at the 60-minute moving average. And right from the open, we've had so much trading range price action. This is the end of the 3rd hour. We have a bull flag. We broke to the upside and we pulled back. So the bulls see this as a breakout pullback buy setup, and the bears are hoping it's simply part of the trading range. I am still bullish over the next week or so. I do not think we'll get above this major lower high, but we may get higher up. So I still think the odds are we've begun 150 point correction, but daily chart, we still may go sideways to up a little bit more. This is a reasonable sell location for the bears. You're in the middle of the most recent bear leg and you're in a bear channel, and we have a reasonable target below. Weekly chart, bulls trying to create a good buy signal bar. Today's a Friday, so they want the week to close on its high or near its high. 20 gap bar buy, but 40 bars above the moving average is so extreme that the odds are, even if we go above this week's high, we'll still be sideways to down for the next 10 weeks or more. All right, so bears trying for a stop entry sell. They're trying to get a decent sell signal bar 36, but unless it's reasonably good, a lot of traders will simply wait. When the range is really small like this and the bars are small, especially in the middle of the day, 9:30 to 11 o'clock or so, 9:30 sometimes to 11:30, I reduce the amount of trading that I do. Probably scale and bears above. Bulls want the breakout and measured move up. Still room to the 19 high, and I think we will get there. So we'll probably get to the 18 high, 19 high. We're within a tick of it, but the bulls have owned now about 15 bars, and the bears are not all that strong. The odds are the bulls will get to their target, the 19 high. So that lowers the probability for bears selling below 36. Do not take that sell despite the wedge. We still have an obvious target above the 19 high, so I think probably buyers below here despite the wedge. You see the similarity. Strong sell-off, weak rally, strong sell-off, weak rally. Here, the bulls got a breakout. Here, I think it's slightly more bearish, but we could still get a bull breakout. We have a micro double top 36.38. The bulls still failing to get above the 19 high. At some point, they give up. We had a double top yesterday, 36.41. Here 36.38. A lot of times, days do similar things at similar times, and that's what's going on here. Downside, probably not great. Some bears want a third leg down to a big wedge. The reason why I think we will not get that, in part, is this rally has gone on too many bars, and as a result, the bear channel is not really wedge shaped anymore. It's a little bit wedge shaped, but not much. Everyone's aware of that magnet, and that makes it difficult for the market to go down here. Again, I don't know that we'll go up all that strongly. I still think 90% chance we will not get above the high of the day. Look at the open of the day, look at the high of the day. All right, so a high, open, did not quite make a measure move down, but it looks like today's going to remain a doji bar. Look at the first 4 bars, doji bar, doji bars. Today could end up remaining a doji day, closing around the open. So the open of the day is an important price. So we went below it, 4 or 5 points. Maybe we'll go above it 2 or 3 points. I don't know, but we'll probably end up closing very close to it, and the day will probably be a doji bar on the daily chart. Reached the target. Bulls hoping for a strong breakout and a measured move up. Yesterday we got the breakout, but not the measured move up. And bears now, I think, are more willing to sell because we reached the target, the top of the sell climax. We still could go all the way up to the 14 low, and that's because buying the 14 low was reasonable. Strong bull trend, and buying the 14 low and then buying more above a bull bar is a reasonable thing to do. Usually you can avoid a loss. So you buy the, let's say you buy the 14 low and you buy more above a bull bar. Let's say you buy above 20. If it goes one tick above this line, then those bulls could exit and avoid a loss. Their loss on their buy at the 14 low is exactly equal to their gain on the buy above the 20 high, so they can avoid a loss. We're only a couple ticks away from that, so the odds are we are going to go at least one tick above the midpoint of the two buys. I think we'll go higher, and the bulls want to get up to the 14 low. They want to be able to get out, break even at the 14 low, and I think that is less certain. Very often it gets close to it, but not quite all the way there. For the bears, they can sell at any time, stop above 7, maybe a stop above 11, knowing that there's a 90% chance that this is not going to go to the new high. Usually on the days when you get a reversal up to the new high, you get a stronger rally early on. So for example, here is a bear break below the 18 bar range, and we got up to a new high. And we had a very strong rally and a pretty good move up right from the outset. Same here, we got to a new high after the bear breakout of the 18 bar range, but again, much more buying. And even this rally is stronger than today. We've had a series of breakouts with good bull bars, and we did not get quite to the 18, to the new high of the day, but came fairly close. And again, this is stronger than today. Pretty good reversal up, pretty small range. So yes, we reversed up below the 18 bar low, but it was a brief breakout. To me, this looks like a bear trap, and it looks like it should get above the 18 bar high. You know, the bears got a brief breakout and the bulls brought aggressively. Failed breakout below the 18 bar range, strong reversal up, but then just sideways. So, you know, my point is that the times when you get all the way back above the high, the failed, okay, so I refer to these as an 18 bar breakout to the downside that failed. It went all the way back above the high. Those days tend to have much stronger buying than what we're getting today. And therefore today is likely to be more like this or this, not quite getting there. No, not like that, but like this, you know. Maybe get some rally, but does not get up there. And the bears will conclude that, hey, we're not going to do it. Or excuse me, the bulls are going to conclude that, hey, we're not going to do it. And they give up, and you get a test back down. One tick above the average entry price. I think we're probably going to get closer to the 14 low. However, because significant targets have been reached, you know, bears will now start thinking about selling. We're in the sell zone. Open of the day, the midpoint for the bulls who bought the 14 low and bought more lower, and then also the 14 low. So we'll probably get a lower high somewhere in this area. I suspect that we'll get closer to the 14 low. And I still think high probability, not a new high of the day. Do I still think 90%? No, as it goes up, the percentage drops, but it's still probably 80% chance that we will not get a new high of the day. If we get up here, then maybe 70%, then 60%, the higher it gets, the more likely it'll get a new high of the day. But right now it's still probably 80% that we've seen the high of the day. It still looks like we're working higher. The pullbacks are very small. We have a spike pullback channel. We got 3 pushes up, but the pullbacks since 34, past 12 bars or so, are pretty small. On the 60-minute chart, a good-looking bull bar, a pullback from the breakout above the bear channel, but a very big bear bar, and that increases the chances that we'll go a little bit sideways. So I still think we're in the sell zone, but right now we're also in a small pullback bull trend, and we have targets above. So I think we'll probably go a little bit higher. The bars are small, the market's not moving, so not a lot of fun trading. But sometimes you go up for a measured move based upon the height of the bull bodies. Takes us up closer to the 14 low. I think a lot of the bears would rather sell up here, expecting a test back down to the open of the day by the end of the day. Because of the wedge and we're in the sell zone, a lot of the bears do not want to sell with a stop below 46. Some bears sold 38 high and or 1 point higher, and it looks like they'll probably make money. We'll probably get below the 38 high, but I still think the odds are we're going to work a little bit higher. So selling here, you probably need to stop up here, and it's better if you can scale in higher. I mentioned earlier that we may get to about a 50% pullback, and you always have some bears selling exactly at a 50% pullback. A lot of times it goes 1 tick above and then reverses, and those bears have scalped out. It's already fallen enough for them to make a profit. It fell 5 ticks from their entry. Bulls trying to keep a gap, 38 high. They want the limit order bears to get trapped, and they try to force them into buying back higher, hoping to get a measured move up. But I think the odds of a measured move up are small. We may go up another leg or so, but I think we'll have a hard time getting much above the 14 low. Everyone wants more movement, but the reality is we're probably going to stay within a few points of the open of the day for the rest of the day. We might get back down to the 30 low. We have a spike pullback channel, bottom of the channel here at the moving average. Might get up to the 14 high, but this is probably the range for the remainder of the day. Buyers will probably come in around the 31 low, spike pullback wedge channel. And if we do break above the wedge top, probably sellers around the 14 low. And we'll probably stay within a few points of the open of the day for the remainder of the day. It's a Friday, so there's an increased potential of some kind of a surprise at the end of the day. But right now, most likely, it'll be a doji day on the daily chart, and we'll close around the open. The odds are that we're going a little bit higher. I don't know if we get all the way there, but chances are we're going at least a little higher. And the odds are we'll end up closing around the open of the day. So sellers above, probably. So far, 4 tick trap for the bears have sold 45. In part, that's because it looks like we probably have to get up to the 14 low. So I think we're still probably going higher. Bears, I think they can be selling above using wide stops, but minimum stop above 11. There's always a possible surprise at the end of a week. Weekly chart, no nearby support or resistance except the high of the week. And that's probably too far above for the market to get there today. This is the high of the week right here. $60-minute chart, 3 consecutive bull bars, but the bodies are getting smaller. So momentum decreasing. I still think we'll trade down before the end of the day. It may be the last 3 or 4 bars of the day, but I still think we'll trade down, and we'll probably stay within a couple points of the open of the day and close right around the open of the day. Similar to 36, the second entry failed breakout 28. Similar to 42, second entry failed breakout above 37. Now we have a second entry failed breakout above 45, but we have a small pullback bull trend, and we have a target above the 14 low and the 15 sell climax high, and a test of yesterday's high. Everything's in miniature, everything's in slow motion. We have a double bottom, a high 2 bull flag, or double bottom, with 62, a breakout 63, and a pullback 64. And we're trying to get higher, but the bears have a failed breakout above a wedge and a second entry sell. However, if you're selling, I still think you need the wide stop. And there's still a small chance, maybe a 30% chance, that we get a crazy surprise move at the end of the day. So we might get a big breakout at the end of the day and back up to the high of the day. Usually, once you've broken below the 18-bar range, especially with a pretty good breakout, even when you get a reversal today, it does not get all the way up to the high. But sometimes it just channels up all day. Sometimes you can just keep going up and up and up all day. This one, it did go to a new high. Just channeled up all day, got a new high. Channeled up all day. Did not quite get to a new high, but channeled up all day. This is a bigger version of what we have today. Again, reversal. Just channeled up all day. Got a small new high at the end of the day. Bulls giving up. Bears target prior higher lows. This is an interesting bar. If it closes around its middle, then we stay sideways. If it closes on its low, then we'll get down to the 34 low, 30 low, 60-minute moving average. But we're still probably going to close around the open of the day. You can see that. Close back in the middle of the bar, back at the open of the day, telling us that we're probably not going to move far from the open. And then 68 becomes important. Do we get a bull bar and a failed breakout and another higher low? For me, it's too high up to be buying. And for the bears, that big tail, small pullback bull trend, the reversal is probably going to have a hard time getting very far from the open of the day. So it makes it very hard to make money. The market's been in a 3-point range now for 3 hours, 2 hours. Limit order bears made money. Stop order bears made money as well. And for the bulls, that close back in the middle of the bar, probably not enough to make bulls buy, but it's certainly enough to make bears scalp out. So the bears who did not take the original opportunity to make a 1-point profit, a lot of them now have moved their limit orders to 5 ticks below 66, trying to get out with 1 point. And if they don't get filled in a minute or two, they'll raise their limit order and try to make 2 ticks. And because the bears will be buying back shorts higher and higher and higher, if they don't get filled, that increases the chances that the breakout will fail. Bulls still have higher low 54, but I think it's really hard to do anything right here. The bears who sold above bars scalped out. The bears who sold below 66 probably scalped, and that's why the 67 bar closed in its middle. And the bulls are concerned that there might be a small second leg down. Maybe we'll get down to the bottom of the channel, pull back here, 60-minute moving average. So the bulls were hesitant to buy, and right now I am trapped out. Not a great buy. Most of the buyers here are bears panicking. They sold one tick below 66, and they've been debating whether or not to get out. And now, if they get out, break even if they're lucky. If we do go up, I still think there'll be sellers higher up, like around the 14 low. I've been saying that we would stay within this band for the end of the day. We might get a couple points below the open, maybe 2 or 3 points above the open, but we're probably going to stay reasonably close to the open, and the day will probably end up as a doji bar on the daily chart. Pretty unusual in the euro for the market to break out this late in the day. I wrote in the morning that I thought we were going higher, that the daily chart, I thought the daily chart looked like the bears had 10 days, 2 legs to reverse down, and they couldn't get it to go below the moving average. And I thought, therefore, we had to go higher. And I don't know if we get much higher than this high, but I thought the odds were we'd go at least a little higher. This happens all the time. A big bar, so the stop is far, the risk is big, and traders are being forced to buy at the top of a channel and the top of a 10 bar very tight range. So the probability of the market going up is not all that high, and the risk is big because the buy signal bar is big. Bulls trying to follow the euro and break into a strong trend. Testing the 14 low. Can you see the profit taking one tick above 14 and it pulled back? That shows you that the scale in bulls, some of them took partial profits, maybe full profits. Bears, I would not short. It's a small pullback trend day and a reversal day. And, it's been reversing up now for several hours. Unlikely to get much of a sell-off. Probably the best the bears can hope to get is a close around the open. The bulls still have a chance of the day closing up near its high. Well, the bears failed breakout. It's really fascinating how, the bulls bought. As soon as they got to the 14 low, they bought. They were able to get a small profit on their, a decent profit, a few points profit on their lower buy, and they avoided a loss on their original buy. I still think we're always in long, and I think the downside is probably not great, but as I've been saying, I think we're going to stay around the open of the day for the rest of the day. This is the window when the market often has a trend at the end of the day. So it's still possible we could get a sell the close or buy the close trend, but we have support very close below all these lows, 60-minute moving average, and resistance just a little bit above, and a big magnet in the middle, the open of the day. So most likely we'll stay sideways. It's Friday, so weekly chart becomes important. So far, it's a decent looking bull bar, but the bears will try to sell it off maybe to the middle of the week and make it a less reliable buy signal bar for next week. Is it sell the close? Well, if it closes here, it probably is. But I think it's not a strong sell the close. Every one of these higher lows is support, as is the 60-minute moving average. So I think it's very difficult to make the math work. If the bars were big, if they look like this, then I think the bears would have a better chance. You can see limit order traders, even at the end of the day, are still buying prior lows, 67. To me, it's not good enough to trade. Technically, still sell at close, but it looks like we're going to have a hard time getting far from the moving average. 3 hours in a very tight range with small bars, and 60-minute moving average just a little bit below. A bear bar, 5 bars down, not a very good stop entry buy, and the sell-off is weak. The bars 73, 74, getting bigger bodies, but still not very big, and then bad follow through 75, 76, and at the 60-minute moving average. If you're an institution, I think you can sell it, but if you're an individual trader, I think it's very difficult to make the math work out. I'm letting it go too late in the day and support 60-minute moving average. Sometimes when you have a doji type day, you get a trend at the end of the day, and then instead of a doji day, you end up with either a bear trend like today or a bull trend if it closes on its high. Let me check the volume. About 90,000 contracts. I think it's a pretty boring day. Not a lot of opportunities to trade unless you were willing to do a lot of fading through here. You're selling above things, buying below things, and scalping. And not a great sell setup here. You get a micro double top. You got sell to close 74, 75, but small bars. And support 60-minute moving average. So I personally would not. I would just let it go. Math is not good enough. Although it worked out for the bears today, it could easily have gone the opposite way. Even though you can say we had an opening reversal down and we closed near the low, or we are closing near the low, and it's a bear trend day, I think of it more as another trading range day. So sideways for 3 days after Tuesday's big reversal. The bulls are hoping bear channel bull flag breakout and a double bottom pullback, break above the neckline, and then a rally. And the bears are hoping lower high major trend reversal, a double top pullback, and a reversal down. Next week is seasonally bullish, and the weekly chart has a buy signal bar this week. A 20 gap bar buy. It's really interesting, with that close down off the high of the bar. Look at the moving average. Can you see that? The moving average is just below the low of the bar, less than a point below the low of the bar because of this sell-off. A few minutes ago, the moving average was above the low of that bar, but this sell-off put the moving average down below the low of the bar. So if we close where we are now, the low of this bar will still be above the weekly moving average, and therefore the odds are we still have to go a little lower. Realistically, as you know, I think we're coming down here. This is probably the final flag on the weekly chart. 20 gap bar buy, yes, but this climax is so extreme, the odds are we're going to correct down 10 bars, 2 legs as an approximate target, and 10 bars on the weekly chart is 2 or 3 months, and therefore I think there are probably sellers above this week's high and sellers above the all-time high, and the upside is limited and will probably come down here. Monthly chart, so far a bear body. It's still possible that the month could go outside down if next week it gets below last month's low. 10 bar bull micro channel, 10 months with every low at or above the low of the prior month. Really, really unusual. And if this month closes like it appears to be closing with a bear bar and a close, somewhere in the middle or below, then September will probably trade below this month's low, and bulls will buy below this month's low because they've been willing to buy above the prior month's low for 10 months. If they finally get to buy below the low, they'll take it. But they may not buy aggressively for 2 or 3 months. So the pullback might last 2 or 3 months. You know, here 1 bar, 1 bar, 1 bar, 1 bar. And here 1 bar, but extended into 7 bars. I think it's probably going to be more like this. This is 5 or 6 bars down. I don't know that we'll get that, but I think we'll get 2 or 3 bars down. You know, maybe like this. Daily chart. I keep talking about this. We're in a bull trend, getting higher lows. We've been in a trading range for a month, or you could say the trading range began here, in which case we've been in a trading range for 3 months, and we're in a bear trend, a broad bear channel. And we don't know what the result will be. I think we have 2 important prices, the lower high and the wedge bottom. A bear trend needs a series of lower highs. If the bulls break above this high, then it's no longer in a bear trend. It's either in a trading range or in a bull trend. If it breaks below this low, then it's probably no longer in a bull trend. Then it's either in a bear trend or a trading range. I don't know if we get the breakout next week. You can see where we are. We're right in the middle of the 2 important prices and deciding, you know, which the market will break beyond. Stop entries today. Well, we have a gap up and a high 2 buy with 4, but not very strong. And then buying above 6, I would not. We have 4 doji bars and possibly a parabolic wedge, 3 pushes up, bar 1 or 3 for the first push, and then 5, 6 for the second push, and that tail on the top of 7 might be the third push. 10, we have a 10 bar bull micro channel, probably buyers below for a scalp. And you can see the traders have bought the 10 low, made a 1 point scalp. It rallied 5 ticks on the 12 high. And then we had a second short tail breakout yesterday's high. On 10, we're reversing down from above yesterday's high, and below 12, we're reversing down a second time. Not a very good looking sell setup, but we got a bear breakout 15 and then 16, so we're probably going lower. We try to get a wedge opening reversal at the 60-minute moving average with 20. I think it's an okay buy if you use a wide stop, because a lot of times you get a little bit more down. You can see they bought below 20, they bought below 22, and therefore, even though 25 is a bear bar and 26 is a big tail, the odds are we're going to go higher. And we rallied for about 4 or 5 hours, and but during the rally, bulls kept buying every low, you know, below every bar, 28, 23, all the way up, and bears kept selling every high, and both were making money, and therefore it was probably a bull leg in a trading range. Most of the time, the bull leg in a trading range continues for the rest of the day, and some of the time it breaks to the upside, and you end up with a bull trend day, open here and close up here. Other times you get a bear trend day, open here and a late sell-off. If we get a little bounce here over the next couple of bars, then we'll probably be closing around the middle, which I still think is probably more likely than not. The bears who did sell the close have to get out either 4 ticks above a bear bar, so not above 76, or 1 tick above a bull bar, which could happen above 79. Stop entries today, well, trading range day, stop entries in general are not good unless you use wide stops. Selling below 12, 14, not all that good. Below 18, probably going down to the 60-minute moving average, maybe yesterday's close, probably a scalp. Buying above 20, only if you're using a wide stop, might get 1 more leg down, sell climax. And selling below 21, I think there'll be buyers below 20. So if you sell below 21 or below 24, you're scalping because there probably will be buyers below. And this will probably be a wedge higher low at the 60-minute moving average. We're finding support in the 60-minute moving average, so possible low of the day. And so far, 25 still is the low of the day. I thought 31, okay buy. 3 bear bars, I thought we might go sideways more. Then you got a little wedge bull flag here, 40, not all that great. High 2, 50, not all that great, wide stop. And then a high 2 buy 56 with 50, 56. Again, wide stop. And selling below these bear bars below 46. If you held, you would have made a 1-point scalp. And selling below any of these bear bars, you need a wide stop up here. Ultimately, you would have made money. And then buying above 67, 68, the bulls made money. Selling below 71, they made money as well. But when the market looks like this, I usually stop trading and I just wait, hoping that we get some kind of a strong move at the end of the day. While we broke out to the downside, it was not all that strong. So I ended up not doing anything from in here. And the rest of the day I was just scalping. Buy the close, sell the close. 5, a surprise bar, so probably at least a second leg up. And you can see it rallied far enough up for the bulls to make a couple points. And then sell the close, maybe 15, definitely 16. But I think probably a trading range day with buyers around the moving average. If you sold the 19 close, disappointed 21, you get out break even on 20. If you sold 19 close, disappointed 20, you bought back your shorts on 21 or 22. And the bears just kept buying back shorts, and bulls started buying new lows, and we reversed up. Buy the close 27. I think we're going 2 legs up. I don't know how much higher. I doubt that we're going to get above the high of the day, and probably not above the 11 high. And therefore, the bull reversal attempt will probably result in a lower high and a close around the open. And the bears got control at the end of the day. It was sell the close 74, 75, but really hard to trade it. The bars are small, doji 75, 76. Limit orders, everything was limit orders. Buying below anything, even buying below 2, you made money. Even selling above 3, you made money. All day long, every limit order trade made money. So a lot of work, a lot of 1-point scalping. But you have to trade the day that you have and not the day that you want. I got to turn on the questions thing. I'll leave it open for a minute and see if anybody has any questions. Al, why do you think that many institutions trade mostly using the line charts, and what made you realize that this is the case? Well, they show it. If you turn on any television show, any business channel show, all you see is line charts. And, they would not be doing that if they were trading on some other chart. They're showing line charts because that's what they use. And they're mainly interested in the close of bars. And, I think what they're telling you is that candlestick patterns are much less important than support and resistance and momentum. And you can see support, resistance, and momentum clearly on line charts. And so I think it's reasonable. I think if you're a day trader, it's easier to trade with candlestick charts because you're looking for every little piece of information to make a quick decision. But if you're trading on daily charts, line charts are fine. A lot of times when I'm trading on daily charts, I don't trade on daily charts. I trade on weekly charts. And, I trade with options, or if I'm trading stocks, it's usually with options. Sometimes I'll buy outright positions or short outright positions, but for the most part, I'm trading with options. And when I'm trading with options, I prefer weekly charts unless there's some special event. Sometimes you'll get some kind of, extreme move with a decent reversal, and I'm planning on holding just for a day or two. And if that's the case, I'll make the decision on the daily chart. There are a whole bunch of stocks that really got hit recently. Because I'm going to be away for the next week or so, I'm not buying, but here's Chipotle, right? It tested 300, a big round number, so you'd expect some kind of a bounce. And then you got a whole bunch of other, just look at any kind of stocks and you just look for, tests of different moving averages, the 50-day, 100-day, 150-day, 200-day. They're all popular with stock traders. and they really tend to ignore candlestick patterns. For the most part, they do. I don't know if you watch options action, but during this sell-off, when the market was right around here, this is the bond chart, daily chart. Their technician was saying that it's a buy. It's another higher low, and it's an approximate test of a trend line, and therefore, it's a buy. And if you're trading candlestick charts, you're saying you're nuts if you're saying that's a buy, a test of the trend line, right? To me, I thought it's a sell the rally, 50% rally for some kind of a pullback, but that he just ignores the chart. All he does is pay attention to the line chart, and he sees the market forming higher low, higher highs, double bottom, and he expects it to reverse up. So he's ignoring the candlestick pattern. And I do think a lot of times candlestick patterns are useless on daily, weekly, and monthly charts compared to how important momentum, support, and resistance are. And I can see a trader not wanting to be distracted by one bar or two bars and miss the trend. And line charts are a way of avoiding missing the big picture. When you take a look at Apple from an always-in perspective, 5-minute chart, it's pretty similar to what took place here. Okay, so head and shoulders bottom, bull flag, and we broke to the upside. I think always in long here, but every bull bar, bull bear, bull bear, bull bear, probable bull leg in a trading range. I would get out of longs below a decent bear bar, like below here, and it probably went short here, probably a second leg down, so I would not buy there. I would get out of shorts over here, and very tight channel, so probably need some kind of a double bottom. Here, not a good buy signal bar. Here, not a good buy signal bar. Here, a better buy signal bar for the double bottom. So I would buy above here. It probably became always in long with one of these bars because of the wedge, 1, 2, 3. I would get out of longs here, and this, I would not trade it. Okay, question, what's the best advice you have for a good trader who has a difficult time keeping his head cool and remaining objective while in a trade, aside from trading small? Well, there are two things that I always say. If you're a scalper and you're nervous, you're going to stay nervous. There's no escape. If you're a swing trader and you're nervous, my old buddy Jay, I traded with him for years online, and he would always, sometime in the first hour or two, put a position on, and looking for like a 4-point move. And he would always have an OCO order and a stop and a profit target, let's say 4 points. And then he'd go away. He'd go to the doctor's office. He was an old guy. He was in his 70s. Or he'd go, boating in his canoe, or he'd go to Walmart, and he'd come back around 11 o'clock or so. So he's gone for 2 hours, sometimes 3 hours. And he traded really, really well. So doing that, once he sensed what the market was doing, he placed his, put his trade on and placed his bracket order, and then just came back a few hours later. And it's a very profitable strategy. I don't think you have to go away for an hour or two, but a lot of times, a good thing to do if you find that you put on a good trade and you exit too early is don't be there, so don't be around so that you can exit too early. For example, especially true on a big trend day. Today's a trading range day, but on a day like Tuesday, right here, it's clearly going up. This is probably the low of the day. So you buy for any reason, and once you're somewhere up in here, it's probably not going to come down here. So you just buy, put a stop down here, and plan to come back in a couple hours. And a couple hours later, it's sideways. Your stop is still down there. Maybe you put it below this double bottom, and you just hold on until it's no longer going up or until the end of the day. So I think that is a good strategy as well. Trading small is important, and then I think relying on your stop, and if you're always taking quick profits on a trade that you believe is a swing, I think the best thing to do is just disappear. Put your orders in and disappear. A lot of times, I place orders in and swing profit taking limit orders, and they get hit right away. That happened a couple times this week. I had 4-point limit orders. I don't remember where they were. Maybe somewhere in here, sell the close, and very quickly it fills me, and I say, oh, it's really great momentum. It may go a lot further, and I don't care. Maybe somewhere in here I bought, I don't remember, and placed a 4-point limit order, and it gets filled, and then all of a sudden I'm out, and I'm saying, wait a minute, this is probably going to go a lot further, and I got to figure out how to get back in again. And usually when I get out, I don't like to get back in either direction for at least a bar or two. However, if you end up, making 4 points several times a week, I think it's a very profitable approach to trading. So, if you can get into a trade that you think is a good swing, you see where the stop is, put the stop in, and then just place a limit order, 4 points for a 4 points profit, and then go away and come back. I think you'll be surprised that, that it's a pretty good strategy. Question: when you add on, do you trail your stop when it moves in your favor? Yes. Whether or not I add on, I always trail my stop. So if I'm swing trading and the market has a new breakout, let's say I'm swing trading along, and the market has a new strong breakout, especially to a new high, I'll trail my stop to just below the bottom of that breakout. To me, that's a major higher low, and I'm constantly moving stops, whether or not I scale in. Sometimes I add to a winning trade, and it doesn't matter. Every time there's a strong breakout to a new strong higher low, let me try to find an example. This would be an example. So anytime there's a strong breakout to a higher low, no matter where I entered, it doesn't matter if I bought here and bought more lower. Once it's done this, my stop is here. And once it's done this, it doesn't matter where I bought. I may have bought down here. I may have bought more here and here. It doesn't matter. As soon as I see a strong breakout to a new high and a bull trend, I'm going to raise my stop on everything to below the bottom of the most recent higher low. This is major. If it's in a bull trend, it should not fall below that. If it falls below that, then my premise of a bull trend is wrong, and I need to get out. A lot of times I'll get out before the stop is hit, but as soon as you get a breakout, a new high, I always raise my stop. All right, hope everybody has a good next 10 days or so. I'll be gone, but I'll be back to trading on September 7th, which is right after that bullish window. Again, I don't know if we're going up before we go down, but I think we're going down. And I think on the daily chart, this wedge bull flag is a trap. I think this set the trap. That big rally on Tuesday made everyone think, not me, but it made people on television think that we're going up. And I think that we're not. I think it's a trap and that we're going down. Okay, hope everybody has a good next week or two, or next week or 10 days or so.